Hello, this is Mr. Smith, and today we'll talk about in this last part of the Academic Economics Business and Labor Unit. That's Unit 3, the last lecture, lecture number 4, an intro to business and business ownership. So earlier we talked about market structure and we looked at how different industries can be categorized, but we also have ways in which businesses can be set up. And so we'll be looking at the different types of businesses, including sole proprietorships, general partnerships, and corporations. There are also some other alternatives, for instance, such as franchises, and we'll look more at each of those later. But each type of business has its own advantages and disadvantages, and so picking the best type depends upon what type of business you'd like to get into and what type of responsibilities you're willing to take as a business owner. So something to take in consideration is, first of all, the cost of startup. What kind of storefront or facility will you need? What type of tools, what type of labor, what kind of investment are you willing to put in? Some businesses you might not need that much of a startup cash on hand, but others you might need a huge amount. So it depends upon what type of business you want to set up. Control versus responsibility. The big thing about owning your own business is you get to make a lot of the decisions, but also that means you have a lot of the responsibility or liability as well. So everything falls on you. So how much are you willing to have? The more liability or blame that you want to share with other people, the less control that you have personally. Do you want to share the profits? And so, also going along with that, if you do end up sharing some of the blame, you're probably going to be sharing some of the profits as well, because there has to be a trade off for that. So, who else are you going to be getting involved with, and how much of the money are you going to share when you make a profit? Also, taxation. The taxes are going to be borne by you in one form or another, but typically, the more control you have, the greater tax risk that you face as an individual. But in some cases, you face a special tax risk, like with a corporation, but we'll talk more about that later. Entrepreneurial ability, once again, that goes along with control. How much creation and innovation do you want to have? And obviously, the more of that you want, the more control that you're going to have to keep as a business owner. And then going along with the liability part, this goes along with risk tolerance. How much risk are you willing to take? If you're willing to pass off some of the blame, that also has the benefit of passing off some of the risk if things go under or you go bankrupt, for instance. Financing, this goes along with the cost of the startup. How much are you willing to start yourself? How much cost of the startup are you willing to personally hand over to other partners, maybe, or a loan? And how much more likely are you to get a loan if there's multiple people involved? And then continuity and transferability. So, what is going to happen to this business once you decide to exit the firm? And so let's look at sole proprietorships first. And this is when a business is owned by an individual person. So sole proprietorships are owned and run by one person, one owner, and that's it. There is no distinction between the business and the owner. So in other words, the owner and the business are one and the same. So let's say this guy owns a fish market. If he is a sole proprietorship, then he and the business are one and the same, basically as drawn up on paperwork, financially, tax wise, and so on. They're all the same. So this is a business where the owner is entitled to all the profit. So he is taking all the risk, so he gets all of the profit that is made. He doesn't have to share that with anyone else once all the bills and taxes are paid. But that means he is also responsible for all debt. So if the company owes money, if it has bills outstanding, then he is responsible for all of that, including the losses that go along with that. So if the company goes under and there's some outstanding bills, he has to pay them. And so in other words, he has all the responsibility. He has all the liability if he gets sued. If he doesn't have proper insurance, that could spread to his own personal finances. And so he has complete liability. This is the simplest and most common legal structure for a business. And we say simple, we mean that it's less complex and it's less complicated to set up than the other forms of organization. It's still a difficult business to run, it's still difficult to set up, but it's easier than the other ones that we'll talk about. So, some advantages and disadvantages of sole proprietorship. Once again, it's easy and inexpensive to form. The owner keeps all the profits. They have complete control and they make all the decisions. They are the final decision maker. They have freedom from government regulation because usually this has the least amount of restrictions. And obviously, it's different from industry to industry. Does a restaurant have regulations to follow? Absolutely. But if you are the sole owner of the restaurant, you're probably going to come across less government regulation than if it included a business partnership, because the state might have special laws about partnerships and they have special laws about corporations. There's no special taxation. So you pay taxes and the business pays taxes at the same time. When you file your 1040 form, you're going to report your business earnings on that as well. It counts the same as your own personal earnings. And there's ease of dissolution because you are the chief controller, so you're going to be able to shut it down all on your own. Disadvantages include unlimited personal liability for the sole proprietor. So once again, as I said earlier, if something happens to that business and you don't have good insurance, then possibly you personally could be liable for that as well. So you've got to worry about it impacting your own personal finances and properties and so on. It's difficult to raise capital because there's just one of you. So if you go to the bank and ask for a loan, it's just you and your credit that you're relying on. And that means you have less collateral or something to put up front that the bank could take if you don't pay back your debts. And so because of that, you are less of an attractive customer for a bank to loan money to, because they want to make that back with interest, and one person isn't more likely to pay that back than two. Limited managerial expertise. Yes, you managed a business for somebody else for 30 years and you're going to start up your business. So you might have a lot of experience, but if you brought on a partner that also had at least just a couple more years managerial experience, let's say they only had 2, then you and your partner would have a total of 32 years experience, but you just yourself is 30 years. So you're going to have limited managerial expertise. Trouble finding qualified employees. Just one person reaching out isn't going to convince people to take the risk to come work for you. But if it has more people involved, you can possibly reach out and grab a hold of a greater pool of people to employ. And the personal time commitment is huge because you're going to be running this yourself. You're going to be making all the decisions. If you drive past some businesses that are sole proprietorships late at night, you still see them in there working at their office with the lights on, and because that's because they have to take care of everything. Even after the employees they have go home, they're still going to have to take care of all of the business problems. And then unstable business life. Things go up, things go down. This is tied to your personal income. So if the industry is doing bad, lots of people don't want to buy fish the next year, then that fish market owner is going to see their personal income fall, and so their personal finances. And so because of that, the ups and downs, it can be unstable. And of course, losses are the owner's responsibility. So if somebody gets sick off the fish and sues and it closes the fish market, then all the bills he had for the ice and the fish that were caught from the previous months, he's going to be responsible for all of that. And then there are partnerships. A partnership is when there's multiple people, and it can involve 2, 4, 6, 8, 10. It can involve all kinds of people, 2 or more people that share in the responsibility. Each partner contributes to all aspects of the business: money, property, labor, skill. So all the different parts that go into it, each partner is going to be involved, especially if it's a general partnership. Each partner shares in the profits and losses of the business. But based on the partnership deal, the paperwork that you originally create the partnership with, you can divide that up into different percentages. It doesn't have to be 50-50, for instance. So general partnerships, speaking of 50-50, assume that profit, liability, and management duties are divided equally among the partners. So if there's 2 people and a general partnership exists, they each get 50% of all of those. If there's 3 partners, then they each get a third, or 33.333% of the profits and liability and so on. If you opt for unequal distribution, the percentage assigned to you to each partner must be documented. So if you want to change those numbers, when you originally started the partnership, you have to have that documented. For instance, if there's 2 partners and one wants 75 and the other ones want 25 because they can't afford as much time or capital or so on, then that has to be written up in the original agreement. And then there's limited partnerships, known as limited liability partnerships, or LLPs. This is a more complex than a general partnership. It allows partners to have limited liability as well as limited input with management decisions. Limited partnerships are attractive to investors of short-term projects. So you have some people that want to limit their exposure. They don't want to be involved as much, and they certainly don't want to be liable. And so this also requires more paperwork and involves more complexity in the beginning. Forming a partnership, you have to register as a business with your state. And so this would be with Pennsylvania, for instance, to use as an example. You're going to establish your business name that has to be official and documented, and your business must be registered, and you have to have a license and permits depending upon, including what municipality you might live in. All of that can be done with each of the state governments, and that's because they don't want unregistered entities out there selling faulty products, not being insured, saying they're a business, but they're not really, just committing fraud and scamming people. That is why all of that is established. Partnership taxes. Most businesses will need to register with the IRS, and they'll need to register with state and local revenue agencies and obtain a tax ID number. In addition, your partnership must file an annual information return to report income, deductions, gains, losses for business operations. But the business itself does not pay income tax. So this is similar to sole proprietorship. Obviously, the taxes are going to be divided up between the partners, but at the same time, their income is also divided up, and the business's income and responsibilities are all the same as the owners. So the only difference between this and sole proprietorship is now, in the sole proprietorship, the business and the individual are the same, but in this case, the business and the partners are the same. So they're still going to file, for instance, whatever they made off the business on their personal income tax. So some advantage is it's still relatively easy and inexpensive to form. A little bit more complicated because of the paperwork and because you're dealing with other people, but other than that, not too complex. Shared financial commitment means that capital coming in, loans that you file for, all of that are being spread across multiple people. You're more likely to get that money. You're more likely to get capital startup funds because you have at least two people putting in your savings or two people going and getting loans. Complementary skills. Each of you has strengths and weaknesses, and you're going to be able to double on those strengths. Maybe one is a book smart person. Maybe one has a good personality and great with people, and so you can draw on both of those. And partner incentives for employees, because now you have multiple people. Maybe one of you is better at attracting employees to come work for you. Maybe one is better at managing them. Maybe one of you knows more people, and so on. Some disadvantages, of course, joint and individual liability. So obviously, the other person makes a bad decision, you could be held responsible for that. And this shouldn't surprise anyone in any relationship. It doesn't matter what it is. There's eventually going to be disagreements, and sometimes there are incredibly successful businesses that are partnerships that are ruined and fold because of disagreement among partners. And then, of course, sharing the profits. Even it doesn't matter what the situation is, 50-50 split, and maybe each one of those partners puts in the exact same amount of hours, someone is still going to interpret that one person worked harder than the other at some point, and so there's going to be a disagreement about the sharing of profits. So that can be a disadvantage, that you don't get to keep all of that money. And then looking at corporations. And this is the big thing. A corporation is a separate legal entity. In a sole proprietorship and a partnership, those companies are the same as their owners, but a corporation is a separate entity, almost like its own individual person. So the corporate personhood is the legal notion that corporations are apart from their associated human beings. And they have some but not all of the legal rights that are enjoyed by individual persons. And so they can enter and exit from contracts, they can buy a property, sell property, they can sue or be sued, just like an individual person can. And in particular, the case Citizens United versus Federal Election Commission in 2010, it basically upheld the rights of the corporation, just like individual people can make political contributions under the First Amendment, just like every other human being can. There are three types of corporations: C corporations, S corporations, and B corporations. C corporations are independent legal entities owned by shareholders or stockholders. They're more complex than other business structures because in order to establish them and operate them, they have their own administration fees. Bigger corporations have their own bureaucracy, just like a government, with paperwork and administrative personnel. And then complex tax and legal requirements, because they obviously require a lot more paperwork to set up articles of incorporation. They have their own special taxes because they have the benefits of an individual person. They also have to pay taxes like an individual person, often referred to as the corporate tax. And when you form a corporation, you must form a separate tax-paying entity. So you, as a human being, if you own part of a corporation, you draw profit off that and you have to pay taxes on it. But the corporation must also pay taxes on that money. So basically, you're going to end up paying money twice. It starts actually with the corporation, They make the profits, they pay taxes, and then they distribute those profits to the owners known as dividends, and then you also pay taxes on that money. And the reason why is because the person and the corporation both have legal rights. So some advantages is there's limited liabilities. If you are a shareholder, you only lose the money that you purchased the shares for. That's it. When a corporation folds, if they're sued for billions of dollars, if you only bought $10,000 worth of stock in that company, that's all you lose is the $10,000. The ability to generate capital through the sale of stock. So you are able, as a corporation, when you sell off part of your ownership, let's say you want to say sell half of the corporate ownership to the general public, for instance, you can sell those stocks and raise cash from it. Corporate tax treatment. Corporations file taxes separately from their owners. So the individual owners don't have to worry about the total amount of profit and the taxes that will be paid on it. And it's incredibly attractive for potential employees because if you want to work for, Bob's Fish Market, that doesn't sound as impressive as Bob's Fish Market Incorporated because that sounds complex. It sounds impressive. It sounds like it has lots of resources. And they usually do have better access to a larger pool of labor suppliers. And then some disadvantages. It obviously is complex. It's starting up and continuing and administrating. The double taxation, the fact that the corporation and the individual stockholders must pay, is obviously something bad. And then the additional paperwork that goes along with the first one, the complexity in it. S corporations are a special type of corporation created through the IRS tax election. So this is a special part of the tax code. An eligible domestic corporation, so here in the United States, can avoid double taxation by electing to be treated as an S corporation. So you can actually avoid paying that second set of taxes. Profit and losses can pass through your personal tax return. So the business is not taxed. Instead, only the shareholders are taxed. Any shareholder who works for the company must pay herself a reasonable compensation. That's part of the requirement. So some advantages: only the wages of the S corporation shareholder who is an employee are subject to an employment tax. That's it. The business expense tax credit. Some expenses that the shareholder or employees incur can be written off their own personal taxes as business expenses. That's one of the benefits. If you own a C corporation, you can't do that. Independent life. An S Corp designation also allows the business to have an independent life separate from its shareholders. And that's something that we didn't mention with the C Corporation, is that it continues to exist. Walt Disney died, the Disney Corporation continues to exist, and the same is true for an S Corporation. Some disadvantages is it has stricter operational procedures. An S Corp requires a scheduled director and shareholder meetings, minutes from those meetings, adoption and updates to bylaws, stock transfers, and records maintenance. So a lot more record keeping that has to happen in order to prove, that they are actually qualifying to be an S corporation. Shareholder compensation requirements. Shareholder must receive reasonable compensation, so you must pay each of the shareholders. Where here in a C corporation, the dividends are paid out, but they don't have to be. So not all shareholders necessarily receive dividends, but in an S corp, a shareholder must receive reasonable compensation. And so that's a disadvantage. Not for the shareholder, obviously, but for the business as a whole. And then a benefits corporation. This is a type of for-profit corporate entity authorized by 30 U.S. states and the District of Columbia that creates a general public benefit, which is defined as a material positive impact on society and the environment. This can include positive impact on society, workers, the community, and the environment. And Pennsylvania is one of the states that has this. Transparency provisions require benefit corporations to publish annual benefit reports. They have to prove that they're actually providing a benefit to society. And they have to prove that from their social and environmental performance, basically providing a lot of paperwork and documentation. They're doing that. And it also has to basically use independent and transparent third-party standards. So they have to show from outsiders also that they're able to do this. So this is different from a C corporation in purpose, accountability, and transparency, but not taxation. And a B Corp elects to be taxed as a C Corp or an S Corp, so it can do either of those. So advantages is it protects the mission or purpose of the C Corp. For instance, notice some of the examples here, like Kickstarter, where they can raise money. So becoming a B Corp gives a company more options or protections if they decide to sell the business to someone else or take it public. A B Corp stands out as a business that has a social conscience. So people know, oh, these have a particular mission and they're going to stick to it because they're required to. And the B Corp may be created via or value via employee engagement and customer loyalty, thereby improving results for stakeholders. So everyone who's involved wants to be a part of this mission, and they're going to be more dedicated and loyal. Some disadvantages: B Corp must provide a lot of proof, a lot of transparency that they're doing this. Annual fees to retain certified B Corp status. And the compliance and government obligations. Most states require publicly traded companies with a B Corp designation to have a benefit director who's responsible for ensuring that the corporation meets its stated purpose. So basically, all the disadvantages are invested in the fact that they have requirements to prove that they're providing a benefit to society. And so there are hybrid forms of ownership. And so limited liability company, or LLC, this is different than a limited liability partnership. An LLC is a hybrid business structure allowed by state law or state statute. And it provides limited liability features of a corporation, so you're not personally as responsible, and it provides tax efficiency and operational flexibility for partnerships. Owners of LLC are called members. Unlike shareholders in a corporation, though, LLCs are not taxed as separate business entity. Instead, profits and losses are passed to the business to each member of the LLC. So in that way, it's similar to the sole proprietorships and partnerships. Some advantages is that members are protected from personal liability, so they can't be found at fault for anything that goes wrong. There's less record keeping than an S corporation. And members distribute profits as they see fit. It's up to the members to decide who has earned what percentage of all profits. So they have some leeways in deciding those types of things. Some disadvantages is when an LLC is formed, the members must decide on the duration of the LLC. How long will it exist? And then self-employment taxes. Members of the LLC are considered self-employed, so they have to pay miscellaneous taxes as an individual person earning money on their own, which can be a little bit complicated. And they must also make their own contributions to various types of programs like Medicare and Social Security. And then there's the limited liability partnerships. This is a partnership in which some or all the partners have limited liability. One partner is not responsible. So maybe you have it written up that they control 25%, but in an LLP, they are not responsible for the other person's conduct. Some states require one partner to be a general partner with unlimited liability. Partners may manage the company directly without electing a board of directors, and profits are allocated among the partners for tax purposes, avoiding the problem of double taxation. So they're not paying a separate set of taxes. The owners and the business are one and the same. So some advantages: they're only paying that one set of taxes. 2, they can limit the liability based on the tastes and preferences of the individual owners. Flexibility: they can write this up in a clever way that fits the needs of each individual person involved in the ownership. So it's incredibly flexible. However, the business life of an LLP is also unstable because you have, a simple partnership where it's divided up 50-50, but this one has all kinds of flexibility. So this partner has these responsibilities, and this partner isn't liable, and this person has to contribute, but this person doesn't. And so that creates a lot of unknown variables and some instability. Limitations on formation. Limited liability partnerships are not recognized as legal business structures in every state. So the question is, what happens if you expand into a state that does not? Of course, Pennsylvania has what is known as a limited liability, limited partnership. And so there can be a little bit different twists placed on these as well. And then there are franchises. And a franchise is a business model that involves one business owner, the franchisor, licensing trademarks and methods to a franchisee. And so a lot of chain restaurants are an example of this, like Kentucky Fried Chicken. So there's the Kentucky Fried Chicken company, and then each individual restaurant can either be owned by the corporation itself, or it can be owned by a franchisee. Someone who said, I have this money, I want to set up my own Kentucky Fried Chicken, but I want the right to use your name, your slogan, benefit off your advertising, and be able to sell your recipes. And so for the franchisor, the franchisee is an alternative to expanding. So the corporation doesn't have to set up all their own individual stores. They can let this up to other people. So it involves less risk when it comes to the franchisee. The name, brand, and recognition, all of this is already set up. Access to expertise and support, so all the information that is going to come out. But you have control over your individual location up to an extent. Obviously, you can't buy a KFC and start selling hamburgers unless that's okay with the corporation. But you have relative control over your individual location when it comes to management and what employees you can hire and so on. The disadvantage is the cost. Buying into a franchisee sometimes requires a fee of hundreds of thousands or maybe even millions of dollars. Some franchisors require you to buy 2, 3, 4, 5 locations. In fact, that's a big push amongst some of them, that you have to buy as many as possible so that way you're fully invested and take the business seriously. On equal partnership, the franchisor sets the rules. This is the food we're going to sell. This is the advertising that we have. This is the way we want our stores to look. And so that is one of the disadvantages. As a franchisee, you don't get to basically make any changes to those areas. And rules of enforcement. The franchisor rules imposed by the franchising authority are becoming increasingly strict because a lot of franchisors have gotten tired of people setting up their chain restaurant in like a little hovel that doesn't really look that nice and it doesn't have that many amenities, and they don't update any of their features. They haven't remodeled since 1970. And so a lot of organizations that are franchisors will often get tired of this and set up stricter and stricter regulations for the franchisees. And by the way, it's possible, this is another type of business organization, but for each of them, the franchisor and the franchisee, they can also be one of the other business organizations that we mentioned. So in a lot of cases, the franchisors are corporations. The franchisees might be sole proprietors, or they might buy up a bunch of KFCs with some partners. So it might be a partnership. So each of the different parts, the franchisor and the franchisee, can be their own type of business organization. For the franchisor, the big, the mother of all of this, possibly a corporation, has access to large amounts of capital for their own expansion. They can get cash flow because, like I said, the franchisees have to pay fees. Sometimes could just be upfront. Maybe it's every year. In addition to the initial franchise fee that can range from $50,000 to $5 million, and this obviously goes up every year with inflation, franchisors receive payments in the form of royalties from each franchisee. That's often on an annual basis. Economies of scale. Once a franchise is established with multiple locations, the company can save for bulk purchases of shipping chicken to all these places, of shipping other ingredients to all these places. And so with those bulk purchases, they can save lots of money in spreading out their business. But for the franchisor, despite all these rules and restrictions that I just mentioned, they don't have full control over everything. So who knows what kind of crazy things are going on within each of the franchisees. And that's why you see sometimes franchisees get dumped because, if some franchisee goes off on some kind of racist tangent in the local newspaper, the franchisor can't stop them from doing that, and they might have to end up severing ties. But in the meantime, they don't have any control over that. Trade secrets. If the success of business is based on trade secret, obviously that is going to diminish once you start involving all these other franchisees in your business. And then overexposure is when you get too many. And you'll see this happen. Sometimes franchises will end up decreasing the amount of restaurants or storefronts they have because they've oversaturated an area. You have 2 KFCs very close to one another, for instance. I mean, what good does that do your business? And mergers and acquisitions. A merger is the consolidation of 2 companies that were operating before as independent firms. And it usually creates, unless part of their agreement agrees to get rid of some of the institution, otherwise it usually involves making a bigger company. And they can either be horizontal or vertical. A horizontal merger occurs between companies in the same industry, so 2 oil companies merging together. Consolidation of 2 or more businesses that operate in the same marketplace, often as competitors before. And is common in industries with fewer firms where competition tends to be higher, for instance, oligopolies. Vertical merger is when you have a buyer and seller relationship, so a buyer and seller merge. So maybe a bakery decides to buy out a sugar or flour producer. Two or more firms that are operating at different levels can merge in order to have a vertical merger. And the logic behind this is that you save money. Like if a bakery owns its own flour company, it is going to be right off the expense now of producing that flour, and you don't have to worry about a middleman in between. And you can save from all kinds of other costs that you can get rid of because now all of this is under one producer in particular. Acquisition occurs when a company purchases the assets of another's business, and that includes stock. So companies can own stock in other companies, property, plants, equipment, technology, and usually permits the acquired company to continue operating as it did before the acquisition. So an acquisition usually refers to a purchase of a smaller firm by a larger one. Sometimes a smaller firm will acquire management control of a larger or longer established company and retain the name because maybe they want the premier or well-known quality of that name. And so the reason why things can happen is attaining quality staff or resources, business intelligence, information that the other company has, accessing funds or valuable assets. Maybe a company isn't that profitable. Maybe they have a lot of cash on hand saved. Your business is underperforming. And so some companies do this to try to expand into some other area. Often that can't be guaranteed all the time. Sometimes all it does is spread the underperforming finances into the other company as well. Accessing a wider customer base. Hopefully you have access to more people, diverse, and then you can get them to come to all the locations or the different parts of your business. Diversification of products. Diversification is almost always good because it decreases your risk in just being in one area or one business or one industry. Reducing your costs and overheads through shared budgeting, administration. You don't have to have as much secretarial staff or management hired. It also reduced competition, and even though that's not a good thing in the respect of Adam Smith's teachings, it still is better for the cost internally. And of course, it does allow for growth. And so here we can see a final chart, the forms of business ownership comparison. And there we can see sole proprietorships, partnerships, LLCs, LLPs, and something we didn't mention with the LLC can still just have one owner or more. And corporations, by the way, there can be private corporations in which all the people hold shares internally. They don't put it out to the public on the stock exchange like the New York Stock Exchange or NASDAQ to sell the shares. And so it's a group of people that are involved together and they don't sell it to the general public. Or it can be a public corporation where they can sell it outright on some kind of exchange like that. And then an S Corp, once again, one or more shareholders. So it is possible to incorporate with only one person.